Fed kept interest rate unchanged at 3.5% to 3.75% with a 9 versus 3 vote. So 3 regional Fed presidents preferred for a 0.25% increase to control the high inflation. This shows a hawkish tone. And Fed Chair Kevin Walsh also had a strong language on inflation. That means the likelihood of an interest rate hike soon is high. Some comments from Fed are the economic activity is expanding at a solid pace. Productivity, growth, and capital investments are strong. Employment kept the pace with workforce. Unemployment rate changed little. This resilience reduces the immediate need for a rate cut. This allows Fed to focus on controlling inflation. June's consumer prices dropped 0.4% month-on-month because of the temporary decline in petrol prices. But the recent renewed U.S.-Iran issues caused oil prices to rebound. For changes in market, immediately after Fed keeping interest rate unchanged, S&P 500 paired its losses and short-term Treasury yield declined. Dollar index dropped a little. Lastly, the next Fed meeting is on mid-September, and markets are expecting interest rate to be increased. U.S. Q2 GDP expanded at an annualized rate of 1.5%. It's a slowdown from Q1's 2.1% growth. However, consumer spending rebounded strongly. The slowdown is not so much on consumer spending, not private domestic demand. It's more towards trade and government-related. Firstly, there's a larger trade deficit. Imports rose sharply, particularly in telecommunications, semiconductor, and industrial machineries. Imports, at the last point in the picture on the right, is part of the GDP calculation, and so is government spending. The second reason to the slowdown is lower government spending. Non-defense spending declined. All these, while underlying demand remained strong. Consumer spending accelerated at an annualized pace of 3.2%, much higher than Q1. Spending was supported by larger tax refunds, rising asset values for wealthier households, particularly if they're heavily invested in equities, World Cup, and midterm election campaigns. Business investments remain robust in equipment, research, software, and AI-related infrastructure industries. These reasons explain the 3.9% growth in private domestic purchaser, which is consumer spending plus private fixed investment. After the news, major U.S. equity indexes increased. The S&P 500, NASDAQ, and Dow futures picked up. However, confidence level still isn't high, as seen in the high yield of long-term Treasury yield. The 30-year yield is at around 5+% now. Investors remain concerned about the high inflation, large government debt, and the direction of interest rate. With private domestic consumption and demand still strong, the potential beneficiaries will be technology and AI infrastructure and consumer discretionary companies. The small caps and the highly leveraged companies will likely face higher borrowing costs if Fed decides to increase interest rate by this year end. Eurozone Q2 economy is more resilient than expected. It grew 0.4% quarter-on-quarter despite the Middle East conflict. Growth continued. Domestic demand turns out to be stronger than expected, but nevertheless, the uncertainty remains high because energy prices will continue to fluctuate. And the impact on economy from high energy prices typically will lag and won't show immediately. And if geopolitical tensions persist or worsen, this is another key risk. So it's too early to conclude that Europe has escaped the effects of energy shock. For equities, the stronger than expected growth is supportive for cyclical sectors like industrial, financials, and consumer discretionary. But markets remain very sensitive to any potential escalation in the Middle East, which could trigger another jump in energy prices. For bonds, because of the resilient growth, likelihood of rate cuts will be lower. This supports the case of keeping interest rates high, which is generally not good for bond prices. For euro, investors remain focused on Europe's exposure to imported energy and geopolitical risk. On to China. Q2 GDP slowed to 4.3% year-on-year and 0.9% quarter-on-quarter. But this isn't bad news. Industrial profit remained strong. It grew 15.1% year-on-year in June. The main reason for slowdown is the falling oil and energy prices, which reduced the earnings boost previously, but it's still supported by strong exports and AI-related manufacturing. The key point here is the global demand for AI-related products from China is still high. And back then, importers, buyers are still buying despite the high prices. So that's why industrial profits jumped much more than now. So, because the recent falling oil and energy prices, profits drop a little, which is very natural. You can see from producer prices dropping 0.3% month-on-month. So while industrial profit is strong, the key problem is still not solved yet. Domestic economy remains soft because of property downturn and cautious household spending. With the global market trends, Chinese semiconductor and electronics manufacturers will continue to benefit. And then AI-related businesses and export-oriented businesses. With resilient profits, these reduce expectations for rate cuts. That means bond prices will not grow much higher, and for currency, strong exports and industrial profits will support the currency. Bank of Japan kept interest rate unchanged at 1% and warned for the first time that inflation could rise above their 2% target. One big reason for inflation is the weak Japanese yen, hence importing a lot of inflation. So, Japan bought yen and sold US dollar in New York market in an attempt to strengthen the very weak Japanese yen. But after Bank of Japan kept interest rate unchanged, the yen dropped again. That showed traders remain willing to sell yen to fund their positions in higher interest rate currency. The US joined Japan in buying yen first time since 1998, after yen dropped to its weakest level in nearly 4 decades. In Japan's part, they support the yen by selling foreign currencies or foreign assets, for example, US Treasury, and use the proceeds to buy yen to push the demand and hence higher currency levels. Then, from US support, the Federal Reserve's Foreign and International Monetary Authority's repo facility allows Japan to use its treasury holdings as a collateral for temporary dollar loan. Repo is a short-term, 24 to 48 hours agreement between two parties exchanging government securities for money and back to the original ownership. Furthermore, the U.S. Treasury reportedly instructed Federal Reserve Bank of New York to sell euros and buy yen to create greater demand for yen, causing the value to rise. The U.S. wasn't helping Japan purely out of goodwill, but to reduce the risk of Japan selling large amounts of U.S. Treasuries. Look at the picture on the right. Japan is the highest holder of U.S. Treasury, and this data reflects December last year. But the fundamental problem is Japan's 1% interest rate is substantially below US's 3.5 to 3.75%. Investors can therefore continue borrowing yen and then invest in higher-yielding dollar assets. For equities-wise, with the higher yen, energy, commodities, and products will be less expensive. Retailers, airlines, utilities, food companies will benefit. But if yen appreciates too quickly, that could force global investors to unwind their yen-funded carry trades, and that could cause some volatility in especially global tech stocks. The stronger yen will reduce imported domestic inflation, which is good for bond coupons. JP lowered its oil price outlook because demand fell considerably more than expected, and commercial inventories declined less than projected. And also, China has adapted to higher fuel prices faster than expected because of the rapid adoption of EVs and charging infrastructure. They also hold a healthy amount of oil backup reserves. JP projected that oil production is expected to return to 90% of pre-war levels in August and 97% in October, and that could push oil price back to roughly $60 per barrel. Lower oil prices will help inflation moderate, hence supporting household disposable income. And that also means reinforcing economic resilience and reduce some pressure for central banks to be hawkish. It's also positive for major oil importing economies, for example, Japan and Europe. But take note, prices will change whenever there's the renewal of Middle East escalation. Linking the topics to the market, highest on the list is CXMT Corp, China's leading memory chip producer. They're benefiting from the global demand for the products that they sell. Next, MUFG. With Japan moving away from ultra-low interest rates, the company benefits from higher spreads in loans, with quarterly profits increased by 48%. Next, Microsoft, relating to global demand for equipment, software, research, and AI infrastructure. Lastly, Randstad. With Eurozone economy expanding and domestic demand stronger than expected, that's a direct equity expression of European economic activity improving. Hiring demand began to recover. Germany also returned to growth. Look at how global market trends affect certain industries. And keep in mind, this isn't a buying guide. This is just to see how trends move the market.